Hello, everybody. Today we're talking about mergers and acquisitions. Take two. I just recorded the entire thing and didn't have the mic on, so round two. I was recently asked to sit on a panel for a group of people that are involved in, helping you sell your company. It involved an investment banker and a tax strategist and an attorney and so forth. And as I was leading up to the day, I just started writing notes down and, like what I went through. I reached out to my business partner and said, what are your thoughts on the things that someone who's going to sell their company should be aware of and be prepared for and all that stuff? So over 3 or 4 days, I amassed a bunch of notes. And then I sat on the panel last night and I said, this would be a great subject for a podcast. So I've assembled a lot of data I'm going to share with you today. If you're an entrepreneur that's looking to sell your company or planning to at some point in your life, lifetime of your business, I think you'll find a lot of this valuable. So I've organized it into certain areas. The first area is financial. So obviously, big part. The first thing, generally speaking, is you need to clean up your finances. Everything needs to be very buttoned up, and it needs to be able to withstand anybody's audit. And you need to get your financial statements cleaned up and make sure it's on track. Basically, here's one thing. If you're an owner, most likely you have what we call owner perks, golf memberships, stuff like that. And you want to make sure you address those and have them very well documented. One way to do it is to have it in your P&L, but under a GL account that's readily available. So the whole purpose is you don't want to have to explain things reactively in the sales process, because you look unorganized and you're slowing down the deal. And you need to know that your suitor, your buyer, is also probably looking at other companies too. And if you're the one that is slow to get information to them, don't have information properly prepared, look unprofessional, your valuation will go down and you might very well actually kill the deal. So another area is in calculating your EBITDA. If you think your exit is going to be measured by your EBITDA, earnings before income taxes, depreciation, amortization, you want to get that as best as possible. I mean, that's the multiplier. So you want to maximize that as much as possible. And you have to get really militant to do that. Maybe you've been running your business a certain way and you're thinking, well, I've got this payment and I pay for this person and I really don't need this, but I do it because now's the time to cut that out. And it shouldn't be some last minute thing. It should be done. And first and foremost, I should have said, this is a 1 to 3 year process. If you're jumping into this and you're really ready to go, you're going to be on defense the entire time. And it's not going to serve you well, not in your valuation, not in the perception of your company. And it's so disruptive. In fact, it'll be the most disruptive thing you've ever done in your business. And it will take more time than you could possibly imagine. So getting ahead of that and proactively carving it out and creating a plan to amass all this stuff is well in your interest. And you definitely want to be, again, ahead of things. If I have to ask you, I'm a buyer and I have to ask you for something that should have been already prepared, that's one thing. But what if I ask you for something and you have it readily available and it's buttoned up and it's documented? The perception of value is increasing. Speak with somebody with knowledge about your financials, the forward-looking financials, and your trailing 12. That's going to come into, there's an analyst that's going to want to show how smart they are. And your best story is the narrative that justifies your asking price. So your, inconsistent profits, forward-looking financials, looking financials, they can demonstrate, for instance, if you have inconsistent profits, it might be because you've made investments in the business, you've done something in marketing or new equipment or whatever it may be. So you want to have this stuff all iterated and documented. You want to optimize your working capital. So analyze your accounts receivable, your inventory, your accounts payable. Make sure it's a healthy cash flow. You have to look at it from the buyer's lens. If I look at this business, am I going to see a cash flow problem? And if so, how are you going to explain that? And maybe it is explainable. Reduce your overdue receivables and any kind of excess inventory. Again, get a militant level of lean, because it's going to serve you in your multipliers. Also address any kind of working capital inefficiencies. You might want to get a valuation, right? Get an evaluation by maybe a certified valuation expert, or you might work with an investment banker who can give you an order of magnitude of what your company will trade at, what multiplier of EBITDA or of revenue. And it'll be enough for you to satiate your curiosity. What do you think my company's worth here today? Kind of thing. And but don't stop sales and marketing. That's not a place to cut. Obviously, revenue sales are very, very important. And like I said, if you're spending all your time doing this stuff, you're not doing, if you're an owner, you might be the selling owner. You might be the person who does the sales, and you can't take your foot off the gas. This next category is taxes. You need to address any kind of compliance around taxes. Do you have your tax filings in order? Your federal, state, local, payroll, sales taxes. Make sure they're current. Make sure they are accurate. And if you have any outstanding tax liabilities or audits, make sure that's all buttoned up. Scrutinize all of that, because that can derail a sale big time. Work with a strategist to determine the best method for you to take the chips off the table. You may have a different idea of what you want to do with the money. This might be a giving time where you can help others in a charitable sense, and also help yourself in the deal because of the way it's going to be taxed based upon whether it's an asset or an equity-based sale. Now we get into operations. There's a lot in operations. Documenting your standard operating procedures is a good business thing to do in general, right? Everything should be documented, all the way down to turning the lights off at night. There's a lot of books written on this, and it goes without saying that if you run your business like a franchise, you put the burger in the microwave for 30 seconds, not 35, not 25, 30 seconds. It is a proven process. We know it works. If you do it this way, it will work. Well, your business needs to have that formula iterated. Everything needs to be documented and organized. It will show your sophistication, and it will increase the value perception of the buyer. If I'm a buyer, I want to see if you're buttoned up. Is this chaos? Are these guys running in chaotic times, or do they have their stuff together, right? So, whether it's a written and documented sales process, a customer service process, whatever that production, everything needs to be documented and organized, and your people trained. Now, while I say that, this is a good time to introduce the Entrepreneur Operating System, EOS, from a book called Traction. If you don't know this is something to go out and seek and implement into your business. It's a system to run your business. And basically what it does is it gets everybody rowing in the same direction. Everyone gets these goals called rocks, and everyone is held accountable to those rocks. And what ends up flushing out in this process is you have a highly in tune operation that's well documented. And a company that sees that you're doing EOS is going to give you the cha-ching in the upward, versus they don't have an operating system at all and it's a cha-ching in the downward. The next thing you want to do is strengthen key customer relationships. Diversify your customer base to reduce any kind of concentration. If you have one or two customers that represent most of your revenue, that's something you need to address, and that is going to be used against you in your valuation, and it may even kill deals. It might just turn people off. So make sure that you are addressing that kind of diversification, and then renew any kind of contracts that are transferable. You need to make sure that any client contracts are transferable in the event of a sale or change of ownership interest. The last thing you want to do, which is what I did, is not uncover that and have to do it last minute and say, oh, please, will you please sign this new contract for me? My whole deal depends on it. You want to get way ahead of that with your client contracts. You want to be able to assign them. And there's two ways to go about it. You can come in a panic and say, I really, really need this. My deal's depending on it. Or you can do it and say, as a matter of practice, we're cleaning up our agreements. Should we ever get acquired by a private equity firm that we want to take our company to the next level, we need to have this kind of language written in there. Maybe it's just a new contract and it's not even discussed unless they bring it up. Oh, we see that you've had this change. This is now transferable. Oh, yes, and then you can address it. Next thing to do is to do a search on Grok or ChatGPT that would, inform you about the kind of business details that you need to prepare in the event of a sale. Some of it is nuanced to your industry, so you might get some good tidbits out of that. The better the prompt you put in there, the better the information you will get back. Basically, button everything up in operations, right? Corporate documents, meeting minutes, employee non-compete agreements, NDAs, literally HR details, literally everything. The more you have documented that, is going to be looked at and scrutinized, the more you have it readily available, the better off you are in every way, including the negotiating price. Also, vendor and supplier agreements is another area. You need to make sure that for instance, our business was IT and we had a partnership with Cisco. It needs to state that should we get an ownership change, that this thing will survive. And if it doesn't, you need to go have that conversation, and you don't want that in the 11th final hour. Next is assessing your technology. Technology and systems. If you have upgrades to do, if I'm a buyer, the first thing I'm going to look at is, it's a very big expense, the IT infrastructure. Do I have to replace everything if I buy this company? Is everything hanging on by a thread? Do they have gaping holes in security? Either I walk or I decrease the value because I know I have to pour a bunch of money into it. So address any kind of inefficiencies in your IT, any kind of outdated software or software that's not supported, and make sure that everything, in fact, is documented so that the new owner can look at it and say, I know the risks, I know the platform, I know exactly where we are. There's no surprises when it comes to tech and infrastructure. Mitigate your risks. Identify any kind of operational risks that you have, such as a reliance on a single supplier or a client or compliance issues. You may have pending litigation. Disclose these proactively because, first of all, it's the right thing to do. Second of all, you're going to avoid any kind of surprises in due diligence. And if this stuff comes up later, it slows the deal down. And again, momentum is your friend. If you're slowing the momentum down, they are talking to other buyers. Always keep that in mind. The next area is human resources. Here's where you need to build a strong management team if you don't already have one. Assuming you do, you just want to make sure that these people are capable of running the business post-sale. And this begs the question, Mr. Owner, Entrepreneur, what do you want to do when this is over? Is this where you want to set sail and go vacation? If that's the fact, you have to be able to demonstrate that your management team is running the business today. Not, hey, after I sell, they're capable of carrying the ball. That's not going to fly very well. So you want to be able to demonstrate that all I do right now is shake the hands and kiss the babies and check the mail. And if that's true, demonstrate that and show that with your corporate management team. And you might want to look at, stuff like exit bonuses and so forth. But before I get into that, employee contracts, you want to look at, that they've signed non-competes, that they have non-solicitation agreements, they have confidentiality agreements in place where they're enforceable. And also make sure that they're all standardized. You don't have 8 different iterations of employment agreements with people. A standardized system is obviously better for a buyer. The next is like what I was just getting into, is planned employee retention. If I'm the buyer, I want to make sure your team's staying. And first you have to develop that they have the will and the want to do that. You need to show that. But you should have a retention strategy for those key people. And then the buyer will probably want to participate in that too. But they definitely want assurances that the critical talent isn't going to be leaving. And if you yourself, the entrepreneur, is looking to move on, you really need to be able to demonstrate they're already running the show. Lastly, about the HR, clean up all the records. HR records need to be buttoned up. It's such a big piece of the business, your human talent. So organize your employee files, including performance reviews, certifications, everybody's licensing, all of that stuff, training records, any kind of notes from HR, any kind of resolved and unresolved HR disputes. Those are liabilities. These things need to be upfront discussed. If you have a discrimination claim, it needs to be disclosed, but address it as much as possible well ahead of time. And if you can, it will serve you well to conclude it as well. Next, we're getting into legal and compliance. So conduct a legal audit. If you have somebody internal to do it, great, but somebody needs to scrub every contract you have with clients, with vendors, with everything. So it's probably best to work with an attorney to go through there, look at your intellectual property, your trademarks, your patents, copyrights, licenses, permits, leases, any kind of gotchas. You might be stuck in a lease and they might not want that lease. So make sure everything's current and make sure everything is transferable. Next is resolve any kind of litigation or disputes, settle any kind of possible lawsuits ahead of time, customer complaints, regulatory issues. Buyers will view unresolved legal matters as red flags, as they should, right? As I would, as you would. So review corporate structure, confirming your business entity, LLC, C Corp, S Corp, whatever, it's in good standing in the relevant jurisdictions. Update your bylaws, your operating agreements, your shareholder agreements. Make sure all that stuff's buttoned up and readily available. At some point, you're going to create this data room, which is where you're going to organize all this data. I highly recommend not going to some data room company that will charge you through the you-know-what to host it. It's ridiculous. You can use Dropbox, you can use SharePoint, you can use OneDrive. But obviously, you don't want this available to every single employee in the company. As soon as if you told 10 employees or 100 employees that you're going to sell the company, 50 would freak out and 50 would be excited about it. So there's no pleasing anybody. So the best thing is to just keep it as confidential as possible because it is disruptive. Maybe you spook a really good employee and then they want to leave and they really disrupt your operation and there go your numbers. And now you have to postpone your sale because you have to make up for something. Very important. Next is prepare for your due diligence by organizing everything within the data room. That's important. It will demonstrate that you're buttoned up. The next category is marketing and brand. So, strengthen your brand presence, invest in your website, social media, go and get online reviews. Make sure that you're showing and demonstrating a modern, reputable brand and that you have a strong digital footprint. That's going to play well in your valuation as well. Analyze your customer metrics. Beyond demographics and the acquisition costs of your customer, compile data on the lifetime value of the basically customer lifetime value, the CLV, your churn rates, your recurring revenue streams, subscriptions, contracts. They're particularly attractive to buyers for good reason because they're sticky. Highlight any kind of competitive advantages. So you're really maybe over here you're working on a PowerPoint with all of these things I'm discussing and how you can turn the observation of it into a presentation where you're showing off these things. We have employees that are excited to stay on post-sale. We have this, we have that. Check this out. Look at this customer data, etc. Highlight any of those that you can and make sure it's iterated properly. Your investment banker is going to learn that and they're going to figure out what the selling points are and so forth, but they need to hear that from you. Why is this important? Why is this important in your particular industry? They might not know why it's particularly important in your vertical. The next is strategic planning. So again, it's a 1 to 3 year process, preferably 3. If you had to do it in 1, it's a full court press. So, and because it is so disruptive, the shorter the period of time you're going to do it, the more disruptive this process is going to be. So if it's out, you can then reverse engineer. Okay, Q1, we're going to have financials in place. Q2, we're going to have our standard operating procedures, etc. Kind of reverse engineer. I want to sell here, then I'm going to reverse engineer all of these things for due dates and so forth. So you also have to clarify whether you want a full or a partial sale. whether you're going to stay. These are philosophical reflections that you must have. What are you going to do after this? And know that is going to it's going to be a material effect on everything, really, the valuation and so forth. But it's really in the eyes of the beholder. Are you selling to a strategic buyer like a competitor, or is it a private equity firm? And if they were to ingest you, would they keep all the people? These are the things, and then if not, how does that affect the financials? Where's the synergy? They're looking, a buyer like a private equity firm is looking for synergies. Where can I save money after I buy this company? This company's spending X, but after we buy them, they'll only be spending X because we already have this talent, we already have this back office operation, whatever it may be. So knowing that is obviously very important, but you might also just go to market saying, well, I'm kind of open to a strategic, I'm open to a private equity. That's what we did. And we looked at them all, and we ended up making a decision for a strategic, and it was wonderful. I would say engage professionals, professional advisors early. Assemble a team. So you're going to need a team externally. You're going to need a good M&A attorney. You're going to need a good tax strategist. You're going to need, at some point, a good wealth manager, because once you get your pile of money, you're going to go like this to somebody. Here you go. Please take care of my money. Excuse me. And you want to know that's in the right hands. So in getting ahead of that, they can help you set up trusts and make sure that your risk tolerance is represented in an investment portfolio. Maybe this is the first time you've ever done that. Identifying your potential buyers is obviously very good to know ahead of time, because then you can formulate your presentation and your analyses of what it would look like post-sale in your eyes, because it is a negotiation. Well, after you buy us, I say this, and they say, well, we don't agree with that. And then there's this back and forth. It is all a negotiation. Nonetheless, that can take months, the negotiation. Once you get to that point, it could be 3 to 6 months finalizing that kind of thing. So now we get into timeline and your execution of it. So like I said, start early, 1 to 3 years. Create a deal timeline. Like I said, figure out, I'm going to have financials cleaned up by Q1. I'm going to do this Q2, etc. And then the next thing to do is practice your storytelling, practice selling the value. Perhaps it's to your investment banker. Maybe it's somebody who's seen the movie before and sold a few companies, and you say, hey, can I take you to coffee and kind of share with you what I think I'm going to say and how I'm going to represent my company, and how I'm going to draw comparisons to particular competitors. This is important. You need to have your presentation skills honed and ready and be confident. So lastly, I'm going to cap this off with the final phases of the negotiating process, and just some simple things. Number one, don't be afraid to ask. If you don't ask, then you have no chance of receiving it. And you might want to not push as far on a certain thing because you feel like it's going to blow the deal. I'm here to tell you, do it anyway. Push. You might say, maybe it's a non-compete. They want 5 years. Well, you want 1 then, and then meet in between. You have to ask. If it's being sweetened with equity, stock in their company or whatever. Maybe it's an earnout. They say, we want to do a 5-year earnout. And you're like, I want to do a 1-year earnout, and I only want to have this much instead of this much in the earnout. What happens when you sell? Well, what happens if there's a downfall in the economy and you don't get your earnout? That happens all the time. And so the company bought your company for a song and never had to pay the balance of it. So really negotiate on earnout, really negotiate on your non-compete. Maybe, they might ask for 5 years. Well, is that really reasonable? I mean, who knows who can profess what's going to happen 5 years from now? I mean, let alone 1. So you want to really dig your heels in on some of these negotiating things, because this is very material and meaningful to you in your life. And then, your employment agreement. That's something that also needs to be negotiated, and negotiated rigorously, because you're going to be married to this company for a while. When it comes to valuations, let's say you have a company and you're doing $3 to $5 million a year in EBITDA. And let's also say that the multiplier for your particular industry is, let's say, 5 to 7 times EBITDA. But if you were to get your EBITDA to like 20 million, that you would get maybe a 12 times EBITDA multiplier. So sometimes it might make sense to pump the brakes on selling your company and go into a roll-up mode where you go and acquire 2 or 3 other competitors and get together with them and say, listen, if we're all going to exit at some point, why don't we just join forces, collectively increase our EBITDA to 20, $30 million, bring us to a new multiplier, and we'll all make out. So that's like 4 days of note taking. I hope some of this stuff is valuable. I'm going to be posting some of this stuff in a documentation form so you can download it. But I want to thank you for your time. And if anybody has any questions, feel free to hit me up, DM me, leave a comment. Please subscribe, like and subscribe if this thing was valuable to you. Be well. Thank you.